Yet there is some good news because the market regulator SEBI has tweaked the norms for companies to raise funds via the Real Estate Investment Trust and Infrastructure Investment Trust, or REITs. Kevin Lee joins in with all the details. So Kevin, tell me, will you be investing in one of these first?
Well, I might be interested in investing in real estate, but before we get to that, Ron, it's also important to note that FPI norms have been relaxed. That means that foreign portfolio investors can now invest directly in the corporate bond market without an Indian trader or broker as a partner. Coming now, as you mentioned, to REITs and InvITs. There are some regulations that are common for both. For example, now both REITs and InvITs can invest in special purpose vehicles that themselves are holding companies for other SPVs. This is a big deal because a lot of real estate and infrastructure projects are set up as SPVs within other SPVs. So big news coming in there. On the real estate side, REITs will now be able to invest 20% of their money in under construction projects. So this gives developers like DLF, K. Raheja and other players who are interested in REITs some much needed liquidity in this crunch market. In fact, UK Sinha, SEBI chairman, believes that REITs and InvITs both should list this year because of these revised norms. Let's listen into what he had to say.
The real issue was that the market was expecting clarity on the tax laws. That clarity has come in the 2016 budget. Based on that and the feedback received, now we are very hopeful that InvITs and REITs will pick up. And as you know, this will generate the possibility of a lot of money coming into the country, even from outside India.
Well, that's the SEBI chief there. So have the floodgates truly been thrown open for investors? Prashant Nair joins us now to take us through that. Prashant, you know, we've been talking about REITs and InvITs and the potential of REITs and InvITs for a while now. But do you believe that the changes that have been made by the market regulator today change the game?
The big impediment why we haven't seen any REIT deals or structures in place is because of the fear of cash leakage. I'll explain that. SEBI regulations earlier essentially said that a REIT must own the physical asset directly. It must house the physical asset directly. Let's assume for a minute that we're talking about a building. The problem was that if an SPV, a special purpose vehicle, owned the building in question, the building was housed in the SPV, to take the building out of that special purpose vehicle and for that to be put into the REIT involved costs. Stamp duty, for example, as high as 6 to 8% in many states. And there are other costs as well. So that caused fears of cash leakage, that not being the most efficient way for investors. And that was a fear as well. SEBI has now essentially said the shareholding of the SPV can be just transferred to the REIT. And of course, the asset transfer happens automatically. No costs involved, no stamp duty and other things. So I think with this one single move, SEBI has taken away the most important, significant impediment to why we've not seen these kind of structures. The other, of course, is the number of sponsors. Usually, commercial property has 2, 3, maybe 4 sponsors, partners, whatever you want to call it. But there might be cases, and there are cases where different legal entities of the same organization own interest in the same asset. That complicates things when you have when the limit set at 3. With SEBI saying, well, there are no limits on the number of sponsors for these structures, I think SEBI has cleared the way for this to be done in a more efficient and faster way. But I think I go back to the first point. The basic issue was the cash leakage, fears of that being taken away by these new rules. Back to you.